Stock Market for Beginners. Section 1, The Basics, Part 2. How to make money in stocks. Ask any financial guru, and they will tell you that investing in stocks is one of the keys to creating long-term wealth. The difficulty with stocks, however, is that while their value can increase exponentially over time, it is hard to anticipate their daily movement with absolute precision. But actually, it is not difficult if you follow some tried and true methods and exercise patience. 1. Buy and hold. Long-term investors have a frequent saying, "Time in the market beats timing the market." What does this entail? A traditional technique to make money in stocks is to adopt a buy and hold strategy where you hold stocks or other securities for an extended period of time rather than engaging in frequent trading. This is significant because investors who often enter and exit the market on a daily, weekly, or monthly basis typically miss out on possibilities for substantial annual returns. People who remained completely invested in the stock market for 15 years through 2017 had an annual return of 9.9%. However, if you entered and exited the market frequently, you compromised your chances of achieving those returns. 2. Opt for funds over individual stocks. Diversification, a time-tested investment strategy, is the key to lowering risk and perhaps increasing profits over time, according to seasoned investors. Consider it to be the equivalent of not placing all of your eggs in one basket. Although most investors gravitate toward two investment types, individual stocks or stock funds, such as mutual funds or exchange-traded funds, experts typically recommend stock funds to maximize your diversification. While it is possible to replicate the automated diversification found in mutual funds by purchasing a variety of individual equities, doing so efficiently might require considerable effort, investment expertise, and capital. For example, a single share of a single stock can cost hundreds of dollars. Funds, on the other hand, enable investors to purchase exposure to hundreds or thousands of individual investments through a single share. While everyone wants to invest in the next Apple or Tesla, the reality is that most investors, especially the pros, have a poor track record of predicting which firms will generate outsized profits. Experts advise the majority of investors to invest in funds that passively track large indexes, such as the S&P 500 or NASDAQ. This places you in the best possible position to profit from the approximately 10% average yearly returns of the stock market. 3. Reinvest your dividends. Numerous organizations distribute dividends to their shareholders, which are periodic payments depending on their profits. When you first begin investing, the dividends you receive may seem insignificant. Nonetheless, they have contributed significantly to the stock market's historical growth. From September 1921 to September 2021, the S&P 500 returned an average of 6.7% annually. However, when dividends were reinvested, that proportion increased to nearly 11%. This is because reinvesting dividends allows you to purchase additional shares, which accelerates the compounding of your earnings. Most online brokers offer the option to automatically reinvest dividends. Understanding primary markets, IPO, and secondary markets. The primary market is where securities or stocks are first sold by a company and bought by investors before they become available for trading on a stock exchange, usually via an IPO. An initial public offering is the first time a private company sells shares of stock to the public. In essence, an IPO means that a company is going from being privately owned to being owned by the public. Because of this, the process of having an IPO is sometimes called going public. The secondary market is where stocks and bonds, issued previously, are bought and sold after being initially offered in the primary market via an IPO. It is what most people think of when they hear the phrase stock market. Stock exchanges like the NYSE and the NASDAQ are examples of secondary markets. What is dividend investing? Dividends are paid to stockholders as a way to reward and entice new investors. A company will share some of its earnings determined by the board of directors and approved by shareholders through a cash dividend or a dividend of stocks. Dividends are paid yearly, quarterly, or monthly. Larger, more established companies with predictable profits and less volatility in price will usually pay the best dividends. Smaller startup companies are less likely to pay a dividend. To qualify for a stock dividend, you must hold the stock or buy before the ex-dividend date. Important dividends dates. Announcement date. This is when a company will announce the dividend rate, payment date, and ex-dividend date. Ex-dividend date. This is the date when traders who buy stocks on and after will not be eligible for a dividend payment. Basically, you need to buy stocks before this date to qualify for the dividend. Record date. Simple put, this is the date the company makes a record of which stockholders are eligible to receive the dividend. The record date is usually the day after the ex-dividend date. Payment date. This is the date when the dividends will be paid to the stockholders. By the way, you can search Google to find these dates for each stock. How do dividend stocks work? Consider the following example. Suppose you purchase 100 shares of a firm for $10 per share, and each share pays a yearly dividend of 30 cents. If you invested $1,000, you would get $30 in dividends over the course of a year. That corresponds to a yield of 3%, which is not bad. Here are some popular dividend stocks that pay dividend yields of greater than 3%. Remember, it is your decision what to do with your dividends. You can reinvest the funds to purchase additional company shares, purchase shares of a different company, save your money, or even spend the cash. How are stock prices determined? When a firm goes public on the stock market and its shares begin trading on an exchange, supply and demand determine the share price. Long-term, however, share prices are decided more so on the business's economics. Other variables can influence prices and generate sudden or temporary price fluctuations. Examples include earnings releases, important company events, political events, and economic news. Market news can cause fear or confidence in a stock price, causing traders to buy or sell. When traders sell, the price drops, and when they buy, the stock price rises. What are stock splits? A stock split is a way for a company to increase or decrease the number of shares it has on the market without changing its overall market value or capitalization. For example, if a company doubles its number of shares by giving investors one more share of stock for every share they already own, each shareholder will own twice as many shares of stock. But the total value of all outstanding shares won't change because the company won't have gotten any more money. The primary advantage of a stock split is that it makes a company's shares more affordable for small investors to purchase. Throughout their history, numerous corporations have occasionally divided their shares in order to maintain a desirable share price. Forward splits are the most prevalent type of stock split, in which a firm expands its share count by issuing new shares to current investors. In the case of a 3-for-1 forward split, if you own 10 shares of firm XYZ prior to the split, you would hold 30 shares following the split. A reverse split is another sort of stock split that operates in the other direction. Existing shareholders' shares are replaced with a proportionally lower number of shares. A 1-for-3 reverse split, for instance, involves the replacement of every 3 shares owned by investors with a single share of stock. Therefore, if you owned 30 shares of a company's stock prior to the reverse split, you would now hold 10 shares. It is crucial to note that a reverse stock split generally, but not always, occurs after a significant decrease in a stock's price. For example, what's the difference between stock trading and investing? Trading and investing both involve seeking profit in the stock market, but they pursue that goal differently. The main difference between trading and investing is that traders jump in and out of stocks within weeks, days, or even minutes, aiming for short-term profits. Investors have a longer-term outlook. They think in terms of years and often hold stocks through market volatility. The focus of traders and investors is also different. Traders often focus on a stock's technical factors rather than a company's long-term prospects. What matters to traders is which direction the stock will move next and how the trader can profit from that move. Investors study a company's potential for long-term growth or value, then buy and hold. But traders often take advantage of small mispricings in the market, such as when political uncertainty in a foreign country temporarily pushes down the share price of a U.S. manufacturer. Scalp traders might be in a position for just minutes. Day traders are focused on a single trading day, while swing traders invest for days or weeks. Congratulations! You have completed Lesson 2. I hope you enjoyed the second tutorial video in this complete Guide to the Stock Market for Beginners video series. Make sure to like and subscribe to never miss a video in the series, and leave a comment with your thoughts and opinions of this video. See you soon. Thanks for watching till the end.